Hi, welcome to Solution in YouTube channel. In today's video, we will learn about call options. So, first of all, what are call options? Call options are financial contracts that give the option buyer the right, but not the obligation, to buy a stock, bond, commodity, or other asset or instrument at a specified price within a specific time period. The stock, bond, or commodity is called the underlying asset. A call buyer profits when the underlying asset increases in price. For example, a single call option contract may give a holder the right to buy 100 shares of Apple stock at $100 up until the expiry date in 3 months. There are many expiration dates and strike prices for traders to choose from. As the value of Apple stock goes up, the price of the option contract goes up, and vice versa. The call option buyer may hold the contract until the expiration date, at which point they can take delivery of the 100 shares of stock or sell the options contract at any point before the expiration date at the market price of the contract at that time. You pay a fee to purchase a call option, called the premium. It is the price paid for the rights that the call option provides. If at expiry the underlying asset is below the strike price, the call buyer loses the premium paid. This is the maximum loss. If the underlying asset's current market price is above the strike price at expiry, the profit is the difference in prices, minus the premium. This sum is then multiplied by how many shares the option buyer controls. So theoretically, profit is unlimited as there is no limit for prices to increase. For example, if Apple is trading at $110 at expiry, the option contract strike price is $100, and the options cost the buyer $2 per share, the profit is $8. If the buyer bought 2 options contract, the profit will be $1,600. Now, if at expiry Apple is trading below $100, obviously the buyer won't exercise the option to buy the shares at $100 per, and it expires worthless. The buyer loses $2 per share, or $200, for each contract they bought, but that's all. That's the beauty of options, you're only out the premium if you decide not to play. Let's take another example. Suppose that Microsoft shares are trading at $108 per share. You own 100 shares of the stock and want to generate an income above and beyond the stock's dividend. You also believe that shares are unlikely to rise above $115 per share over the next month. You take a look at the call options for the following month and see that there's a 115.00 call trading at 37 cents per contract. So, you sell one call option and collect the $37 premium, 37 cents x 100 shares, representing a roughly 4% annualized income. If the stock rises above $115, the option buyer will exercise the option and you will have to deliver the 100 shares of stock at $115 per share. You still generated a profit of $7 per share, but you will have missed out on any upside above $115. If the stock doesn't rise above $115, you keep the shares and the $37 in premium income. Now let's move on. The next question coming to your mind is, why would I buy a call option? Investors will consider buying call options if they are optimistic or bullish about the prospects of its underlying shares. For these investors, call options might provide a more attractive way to speculate on the prospects of a company because of the leverage that they provide. After all, each options contract provides the opportunity to buy 100 shares of the company in question. For an investor who is confident that a company's shares will rise, buying shares indirectly through call options can be an attractive way to increase their purchasing power. I hope you have now basic knowledge about the call options, how they work and how investors can make profit out of it. If you want to learn more about call options, click on link. Please hit the like button and don't forget to subscribe for more videos. Take care.